It's Wednesday, 15th of July, 2026. Welcome back to your news update on Blip Brief. Crisp, but almost everything updated every market trading day. We are diving straight into the Middle East today because, frankly, this severe military escalation is dictating absolutely every move the global and domestic markets are making today.
Yeah, over the last 24 hours, the geopolitical landscape has, well, effectively been rewritten.
Right, the United States has launched a third round of military strikes and, crucially, reinstated a strict naval blockade on all Iranian ports.
And the retaliation from Tehran was immediate. I mean, they executed what is being termed Operation Nasr II, which involved this highly coordinated barrage of drones and missiles striking U.S. military assets in Bahrain and Kuwait.
So we are looking at a very significant expansion of the conflict theater.
Massive. And to add, another layer of volatility, former U.S. President Donald Trump has issued a stark public threat. He's stating he will authorize strikes on Iranian power plants and bridges next week if diplomatic talks do not resume immediately.
Wow. Okay, so for anyone holding a portfolio right now, the ripple effects of this specific geography being a war zone, they're immediate. You are looking at the Strait of Hormuz effectively being choked off.
Which is the world's most critical oil artery.
Exactly. And the immediate reaction is exactly what you would feel, right? Global crude oil prices have spiked over 9% in just a matter of days.
It is the textbook definition of a supply shock. When the Strait of Hormuz is compromised by a naval blockade and active drone warfare, you are essentially bottlenecking roughly 20% of the world's total global oil consumption.
Right, because the maritime insurance premiums alone make shipping prohibitive.
Exactly. So that risk premium gets priced in instantly, causing that near double-digit percentage spike in crude. It just forces a complete recalculation of inflation trajectories and input costs for manufacturing globally.
But here's where I am struggling to understand the logic of the trading floors today. If the world's most critical oil artery is blocked and oil is spiking by nearly double digits, why aren't global equities in a total freefall? I mean, it feels like the market is walking through a minefield with noise-canceling headphones. You would expect sheer panic, limit-down circuits, an absolute flight to cash.
Yeah, but instead the equity drop feels almost muted.
Exactly. Why?
Well, that disconnect between geopolitical reality and equity resilience is what institutional trading desks are currently calling the taco trade.
The taco trade.
Yeah, taco stands for Trump's art of the comeback or Trump's art of the cut-a-deal. Markets are essentially looking past the immediate kinetic military action. They are betting heavily on his historical tendency to escalate tensions precisely to force a high-stakes televised negotiation.
Ah, I see. So when they hear a threat to bomb bridges next week, the algorithmic trading models view that as a heavy-handed negotiating tactic.
Right, rather than the opening salvo of a permanent global war,
Yeah.
the data and the price action back up your suspicion completely. I mean, capital markets are an incredibly cynical but highly pragmatic entities.
So they are treating this blockade and the reciprocal strikes as a temporary, albeit severe, pressure point.
Precisely. The models are pricing in a sudden de-escalation and an eventual diplomatic off-ramp, rather than a protracted, multi-year closure of the Strait of Hormuz.
Because if the consensus believed Hormuz was closed permanently,
The equity sell-off would be historic. Instead, they are holding their breath, absorbing the 9% oil spike, and betting on a deal.
okay, let us bring this back home to Dalal Street and unpack how this imported pressure actually hit our domestic markets at yesterday's close. We import over 80% of our crude requirements, so this is not some theoretical macroeconomic exercise for India.
No, not at all.
It is a direct hit to the balance sheet.
And the reaction on D Street was definitively negative, though perhaps insulated slightly by that global taco trade sentiment we just discussed. Both the BSE Sensex and the Nifty 50 closed down roughly 0.7%.
Which is a noticeable dent reflecting the inherent vulnerability of our macroeconomy to imported energy shocks.
Right, and we saw the predictable flight to safety. Gold closed up over 0.7%, and silver jumped nearly 1.3%.
When geopolitics gets messy, precious metals shine. But looking at the dashboards, the real casualty here, the metric that tells the true story of this oil shock for India, is the currency.
Yeah, the rupee has taken a substantial beating. It slid to an 8-week low at yesterday's close, which brings its total depreciation to 1.4% for the current fiscal year.
So to understand why this happens so mechanically, you have to look at the dual dynamic of an oil shock for an emerging market like ours.
Exactly. First, high crude oil prices naturally widen our trade deficit. Indian oil marketing companies have to purchase more dollars to import the exact same volume of oil.
which creates massive structural demand for the greenback, inherently weakening the rupee.
Yeah.
I want to make sure I'm mapping this out right. We have the trade deficit pulling the currency down from one side because of the oil import bill. But there is a secondary force pushing it down as well, which is the capital flight out of the equity markets.
That is the double whammy. Concurrently, foreign institutional investors assess the global risk landscape missiles flying in the Middle East, oil spiking, and they decide to flee emerging markets entirely to manage their risk.
They liquidate their Indian equity holdings.
Right. They take those rupees, convert them back into U.S. dollars, and park that capital in the safety of U.S. treasuries. This massive outflow of capital compounds the sell-off in Indian equities and puts intense secondary downward pressure on the rupee.
Which brings us to a fascinating, almost paradoxical situation in the broader Indian macroeconomy. Sitting here in Delhi, analyzing the latest data coming out of North Block, there's a glaring contradiction that directly impacts the listener's wallet and portfolio.
Oh, the domestic data is currently presenting a sharply divided picture of the economy. It's representing a classic K-shaped reality.
Right, because on one hand, the wholesale inflation index has hit a 27-month high, coming in at nearly 10%. Retail inflation has also breached the Reserve Bank of India's upper tolerance band by climbing over 4%.
The cost of living, particularly driven by volatile food prices and the surging fuel cost, is severely pressuring the average citizen.
But on the exact same day, we get data showing net direct tax collections have jumped by over 16%. And within that bucket, corporate tax collections have soared by a massive 22%.
The divergence between a squeezed consumer and record corporate tax receipts is one of the most important macro trends to understand right now.
So how are we squaring this circle? We have runaway inflation driven by fuel and a patchy monsoon destroying household budgets, yet corporate tax collections are up over 20%. Are Indian companies just passing every single input cost down to the consumer without taking any hit to their own profit margins?
The short answer is yes, they are. What you are observing is the intense resilience and pricing power of the formal sector, particularly the top-tier publicly listed corporations.
So the Indian economy is operating on two very different tracks.
Exactly. The West Asia conflict pushing up oil, combined with erratic weather patterns hurting agricultural output, is absolutely driving up the basic cost of living. That explains your retail and wholesale inflation data.
Right, the very real pain you feel at the petrol pump and the grocery store.
But corporate India's balance sheets remain surprisingly robust because the largest companies have successfully consolidated their market share over the last few years. They possess the sheer pricing power to pass those increased input costs directly onto the consumer,
Whether through direct price hikes on the sticker or through shrinkflation.
where they give you less product volume for the same price. They are aggressively protecting their operating margins.
It is the toll booth analogy. The top-tier companies own the toll booths on daily consumption. Regardless of whether it is raining or the price of gas is up, the consumer still has to pay the toll.
That is a perfect way to conceptualize it. So while the broader population feels the pinch of a 10% wholesale inflation rate, the corporate sector is generating record profits.
Which translates mathematically into that 22% surge in corporate tax collections.
Exactly. It is a testament to the strength and formalization of the top end of the economy, but it highlights a growing disparity in underlying consumption power.
Let us zoom in on how specific companies are navigating these exact crosscurrents. Let's move from the broad tax numbers to the daily corporate scorecard. Because when you look at domestic equities, it is a highly fragmented reaction to earnings.
It is entirely sector and company specific right now. The market is rewarding operational efficiency and punishing any sign of weakness. For instance, Landmark Cars saw their stock surge over 19% at the close, and Just Dial jumped nearly 17%.
So these are companies finding ways to tap into very specific pockets of resilient domestic demand despite the macro headwinds.
Right. But the punishment for missing the mark or lacking that pricing power is brutal. Hardware India plummeted over 19%.
Wow. And then we have the technology sector, which is facing a massive reality check that we need to unpack. IT giant HCL Tech tumbled 4.5% after analysts aggressively cut their price targets following their Q1 results.
To understand that 4.5% drop in HCL Tech, you cannot just look at their individual balance sheet. You have to look at the tectonic shift happening in the global technology landscape.
The HCL downgrade is a symptom of a much larger disease affecting enterprise tech.
Yes.
You are talking about the historic bloodbath we saw on Wall Street yesterday with IBM. IBM shares crashed by 25%. That is their worst single-day drop in the history of the company. A quarter of the company's total market value completely erased in hours.
And the rationale behind IBM's historic collapse is the exact same theme punishing Indian IT services right now. It is what analysts are calling the AI trap.
The AI trap. Okay.
For the last 2 years, every company promised investors that artificial intelligence would be a massive immediate revenue multiplier. But the reality of corporate spending is playing out very differently on the ground.
It comes down to finite enterprise budgets. If a Fortune 500 company is spending millions on one new technological initiative, they have to cut that capital from somewhere else.
That is the core of the AI trap. Corporate spending is rapidly shifting away from traditional software licenses, legacy cloud migration, and standard IT consulting services.
Which were the cash cows for companies like IBM and the Indian IT majors?
Exactly. Today, that money is being aggressively redirected toward massive physical data center infrastructure. We are talking about graphics processing units, advanced liquid cooling systems, and physical server racks.
It is like buying incredibly expensive state-of-the-art paint for a house, but then realizing you have not even poured the concrete foundation yet.
Right. The enterprise clients realize they cannot run advanced AI software without the foundational hardware to support the compute load.
So the capital expenditure is flowing exclusively to hardware infrastructure, starving the traditional software and service providers.
IBM faltered, and Indian IT is stumbling because they're historically reliant on the software and services side of the ledger. The market has realized that if a company is not providing the foundational physical hardware to process AI, their margins are going to be severely punished.
The enterprise client is basically saying, we don't need another software consultation, we need raw compute power.
Exactly.
Which means the real technological frontier right now isn't in a new line of code. It is in the physical space.
Yeah.
Since traditional software is taking a hit, capital is flowing into hardware innovation. And that context makes the latest leak from Silicon Valley make total sense.
Oh, you are looking at the pivot toward embodied AI. The reports regarding OpenAI's hardware division highlight this perfectly.
Yes, OpenAI is reportedly developing its very first piece of proprietary hardware. But it is not a smartphone to compete with Apple, and it is not a laptop. It is a screenless speaker that can physically move around your environment.
This represents a profound paradigm shift in how humanity interacts with computing. Up until now, our relationship with artificial intelligence has been entirely constrained by digital screens.
Right. The AI is a tool trapped behind the glass of your phone or your computer monitor. You must consciously engage with the device to interact with the model.
It is a destination. You unlock the phone, you open the app, you type a specific prompt, and you wait for an answer. The burden of interaction is entirely on the user.
But by removing the screen and adding mobility, adding spatial awareness through LiDAR and acoustic sensors, the AI transitions from being a passive tool you use to an ambient, physically present entity in your environment.
It is the physical embodiment of large language models. Think about what it means for a device to navigate a room, to follow you while you speak, to observe the physical context of your home or office, rather than relying on you to type out a text description of what you need.
It flips the dynamic entirely. If I'm in the kitchen cooking and I drop a glass on the floor, I do not have to pull out my phone, open a camera, and ask an app what to do.
Right.
A mobile sensor-equipped device can hear the glass break, physically navigate to the kitchen, assess the hazard using its cameras, and proactively offer assistance or warn others in the house to avoid the area.
It bridges the gap between digital intelligence and physical utility. And the reason this is revolutionary is that it aligns perfectly with that AI trap capital shift we just discussed.
Software alone is hitting a ceiling of utility.
Exactly. To truly integrate AI into daily human life and unlock the next $1 trillion of enterprise value, it requires a physical presence. It needs to observe and navigate the real world alongside you.
A screenless moving speaker is the absolute foundational step toward autonomous robotics, powered by advanced reasoning engines. It is no longer just processing text, it's processing physical space, physics, and real-time human behavior.
It's the future.
So if our AI is no longer confined to a glowing rectangle in our pockets and can instead move freely around our homes and offices, observing, listening, and physically reacting to our environment, how long before we stop treating it as a software program and start treating it as a new kind of synthetic colleague or companion? And just before you go, a quick note. This deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most. The content shared here is for informational and educational purposes only and should not be treated as investment or trading advice. Past performance is not indicative of future returns. We are not licensed financial advisors.